I'm assuming that once you have pain of some kind, okay, which is going to be unemployment, which could be a severe market correction, anything that causes a lot of pain, I think they will immediately switch gears, and you won't even hear about 2%. I think the worst part will be ahead of us here over this next 1 or 2 quarters.
The Federal Reserve, Fed, maintained interest rates during the recent Federal Open Market Committee FOMC meeting on November 1st, 2023. This decision followed the July rate hike, establishing the Fed funds target rate between 5.25% to 5.50%, the highest since 2001. The FOMC will render its next interest rate decision in mid-December. Powell also clarified that the Fed will retain rates at current high levels for an indeterminate period. The fact is the committee is not thinking about rate cuts right now at all, said Powell. Despite Fed Chair Jerome Powell hinting at possible future rate hikes in his recent speech, the central bank has paused further increases, holding the federal funds rate steady in both September and October meetings. Financial expert Ted Oakley, managing partner and AMP founder of Oxbow Advisors, criticized the decision to unnecessarily keep rates at 1/4 point. He points out that policymakers' focus on controlling the economy, partly stemming from an overestimated sense of importance, leads to the belief that consistently low interest rates could sustain perpetual economic growth. Despite immediate benefits from such interventions, Ted cautions about the potential for significant long-term issues. He expresses concern, especially for older individuals, foreseeing unforeseen financial challenges due to delayed effects from inflated property values and stock prices, catching many off guard and causing preventable economic damage. Powell reiterated the Fed's commitment to lowering inflation to its 2% benchmark target, although the current year-over-year inflation rate stands at 3.2% per the latest Consumer Index report. The Fed's strategy to curb inflation involves increasing benchmark interest rates to discourage spending. However, Ted doubts the Fed's capability to achieve the 2% inflation target, suggesting that striving for it might lead to more significant economic challenges. He even proposes the necessity of higher inflation to manage the federal debt, warning about the risks of an absence of inflation, potentially pushing the federal government to a critical breaking point. We will present Ted Oakley clips in an interview with Thoughtful Money. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The whole thing was really, unfortunately, it was probably some of the worst decisions that have been made in the country, not only in the Treasury, but in the Fed. I mean, for them to keep rates at 1/4 point when they didn't need to be, okay? And they all got caught up in controlling the economy to want to, I think it was an ego thing. You know, we can keep this thing going, and which they did with this low interest rate environment. No, but it was like we had all these academics that had no idea what's going to happen or go on the street. And it was the federal government, and Yellen was a big part of that. And in addition to all the Fed chairmen, including her. And they just got caught up in this idea that the Fed can control the economy, and it can on a short-term basis, but later on, you know, it comes knocking. And I think that's what they ran into and realized that, oh goodness, we probably shouldn't have done that. The end of these things is where you have the worst damage. That's where you have people think that, you know what, I heard it was coming and I thought it was, but nothing, I never saw anything, but now it's here and I wish I'd done something about it. It's sort of that idea when you get there. And this lag effect's bigger because you had more money in the system. And so people have been able to think more positively about things. You know, their home prices are up and their stocks have stayed up to a degree. And so they, you know, that's the mode they're in. And so the lag effect will catch a lot of people by surprise, I think. And unfortunately, I think a lot of people will have some damage they don't need, especially for older people. You know, I got to get to the 2% level. I think when you have pain and there's a lot of pressure on the pain, you have an election year too, remember, that I think they could fold up on you really quickly. So I have no idea what they'll do, but whatever they do, I think will be something that they've waited too long on, which is what they do both ways. The idea that they'll get back to 2% inflation is probably not going to work, in my opinion. And if it does work, then we probably have bigger problems than we're thinking right now. I almost think you have to have, I almost think you have to have some inflation more than we've ever experienced just to get out from under the federal debt, the federal debt itself. I mean, if you don't have inflation, you will get to a breaking point with the federal government.
The U.S. federal debt, recently reported by the U.S. Treasury Department on October 26, 2023, has surged to a staggering $33.67 trillion. This marks an alarming increase of $2.27 trillion since the temporary suspension of the $31.4 trillion debt ceiling occurred on June 3, 2023. This suspension is set to expire at the beginning of 2025. Despite economic growth falling slightly below expectations with GDP at 4.9% for the third quarter of this year, a concerning dynamic is emerging. If interest rates surpass economic growth, the burgeoning debt becomes a financial noose, tightening around the nation's economic stability. TED highlights parallels with post-World War II debt trends, where the U.S. faced a comparable debt-to-GDP ratio of 375%. He points out a 30-year inflationary phase post-World War II that effectively reduced the debt burden relative to nominal GDP. Given the current inflationary trend, TED recommends a cautious approach, suggesting shorter-term bonds, under 60 months, over longer-term ones, 25, 30 years, to mitigate potential losses for investors. Discussing the bond market, TED observes that the continual decline in foreign countries buying U.S. Treasury bonds for the past 2 years is noteworthy. He dismisses concerns about finding buyers, suggesting that the federal government could enforce measures, such as requiring a certain percentage of bonds in pension plans or IRAs, to stimulate demand. Let's get back to the interview.
If you looked at the end of World War II, 45 and 46, you had roughly the same amount of debt relative to GDP that we have today in the federal government, 375%. And what happened is you spent the better part really of 30 years, more and more and more and more inflation. So by the time you got into the late 60s and the 70s, you were really in, that inflation kept building. But what it was doing was it was all the debt that had been issued was shrinking that debt relative to nominal GDP. That's what I'm saying. So this time it may be a situation where, and I have no idea what it will be, but I think it may be a situation where you need to be balanced. I'll say that because you need some short paper, because if we do stay in this inflation era, you have to have paper that's, in our opinion, you have to have a lot of it that's less than 60 months, because you have to wait it out, and you can't wait out 25 and 30-year paper. I mean, most people can't. But we've had such damage in it, Adam, already. If you had a long-term bond in January of 21, I mean, you're down 45 or 50% on it, maybe more. And that's like a stock return. And now those people that own those and those bond funds like that, you just think about it, they've got to make 100% in a bond fund or a bond to get back to break even, which is going to be tough. I don't see it, but that's where we are. When you get down to this point, okay, you've taken a lot out of the bond market. You've taken a lot of people out. It's interesting, the individuals keep buying into it all the way down, and maybe the damage goes on a little bit longer, but I wouldn't think so, because if you get market weakness and you get economic weakness, you're going to get strength in the bond market, because they'll go to the Treasury market, always do. So that would be what I would be thinking, that those two would go hand in hand, that you'll have weakness on one side, will give you some strength in the bond market on the other side. And it's always interesting to me. I always jot down what I'm thinking for the next year, and I'm normally wrong. If one of my thoughts were the first week in January,
Yeah.
I'm thinking, okay, I don't trade that way or invest that way. I just get to thinking, okay, what could happen this year? What's going to happen? And we're all anchored in what's been going on, and that's the problem. It's hard for people to say, I wonder what could change that. And we're always asking that question. But what would change it are bad times. You get into bad times, and the rates are not going to stay where they are. People will flock to the Treasury. If you look at it, from foreign countries buying, that's been declining now for 2 years in a row. I mean, they're not buying, they keep on buying less and less and less
Right.
treasury. People will say, well, we want to have a buyer. And I always want to say to them, well, don't discount the federal government, because, you know, back in World War II, you had to buy the bonds. You could, you know, you couldn't own your gold. And so I always thinking, well, what could they do? Well, they could say, well, if you have a pension plan or an IRA, you have to own 30% US bonds, and then problem solved.
Mm-hmm.
Yeah, there's all kinds of things they can do if you want to keep it tax-free, that is. There's all kinds of things the Fed can do. I didn't ever put anything past them. So I just think that people today need to really have their head on straight to make sure they've got a pretty good balance of things so that they can get through things, you know, not be all in on just one thing.
Looking ahead, economic uncertainty is fueled by criticism of maintaining low interest rates and doubts about the effectiveness of the current strategy to meet the 2% inflation target. Gold and silver may become preferred assets in this environment, providing stability amid economic uncertainties. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.